Today I'm showing you a stupid simple forex trading strategy that I personally use to find high probability setups in the forex market. I recently funded a small trading account with $200 to demonstrate this strategy in real market conditions. And over the last couple of weeks, it has been performing really well. Now, it needs to be said, this video is not about getting rich quick. It's about trading smart and consistent with a small trading account. Remember, I've been trading forex for over 10 years. I lost a lot of money before I became consistent, so please take your time to learn and test everything on a demo account before you invest any real money into forex trading. With that being said, hopefully this trading strategy will help you get one step closer to being a more consistent and profitable trader. So let me show you the strategy, and it's extremely simple. So step number one is to check the higher time frames and confirm the trend direction. Okay, so to identify the trend clearly, we want to use at least two time frames, which is the higher time frame bias and your entry time frame. In this case, since this is a swing trade on the daily time frame for Euro US dollar, we would be looking for higher highs, higher lows, higher highs and higher lows one more time. And we would go on the 4-hour time frame to actually find a precise entry. So let's say if you're scalping, maybe you would be using the 15-minute chart and your entry chart would be 1 to 5 minutes. In forex day trading, pretty much the same thing. Hourly time frame would be your higher time frame, 15-minute would be your entry. So this concept works with all trading styles. If you're still a beginner trader, don't worry, there is actually an indicator called higher high, lower low, which actually shows you nice little pushes and exhaustion kind of phases in the market, giving you a clear directional bias you can use to enter your trades on. Step two, we want to look for a candlestick that made a sudden move. So let me give you an example. Here was a nice bearish push towards the downside. We can see this happening here because of the free candlestick formation, a nice strong impulse candlestick towards the downside. A second candlestick, which is the base, it pretty much had a little pullback, and another impulse candlestick shooting towards the downside. So this is a drop base drop scenario, and because it was never touched, as you can see, 1, 2, although it was nearby and it reacted, there was no touch in this zone. It means this zone is still fresh, which means there's still a lot of unfilled orders in this area, and that is what we want to catch. So if you wanted to enter the trade, this is what will happen. As you can see, we are trading with the higher time frame bias. By the way, this is the 4-hour. You would be trading off the daily chart, and as you can see, a beautiful trade towards the downside, just because we are trading off the supply area zone. Always make sure to cover the previous area zone high with your stop loss, and this is what a perfect trading scenario looks like using supply and demand. Okay, so let's continue looking at this chart, and some of you may have noticed that there could have been a demand area zone somewhere over here, because it's a impulse move over here, little basing candlesticks maybe shooting towards the upside. Maybe you would be expecting a push towards the upside over here till this impulse move, and then a continuation towards the downside. This could be a good reversal trade in theory, but trading reversal trades against the dominant trend is never a good idea. So even though you found a great demand area zone that looks perfect, unless it's on the monthly and weekly time frames, higher time frame context, and there's other indicators we're gonna talk about later on, then it's probably not a good idea to trade it. So let me show you what would actually happen. So we have this area of demand zone playing about a little bit. Maybe if you were scalping, you could have made some money there, but if you're swing trading, look, it went through like a hot knife through butter. And this is what happens. So if you trade against the dominant trend, you're gonna get burned. You have to trade with the trend. That's the only way supply and demand truly works and gives you an edge in the forex market. Otherwise, you're risking losing your capital. So if we take a look at the chart one more time, the supply and demand zone is great in theory, but you still need confluence. And the only way to get confluence is to use a few indicators. Now, I like using round levels in forex, especially because I read this article where some guy in Wall Street backtested, round levels, and they work really well. They're not gonna make you a millionaire, but they work really well in context if you use it correctly. So round levels and monthly pivot points, that's what I like using. So look at this over here. Round level respected a little bit, then broke out, respected a little bit, broke out. You shouldn't expect, the round level to be your entry trigger, by its own at least. Same thing for the monthly, as you can see, kind of broke out. You shouldn't use it like this. You use it with the combination of a supply or demand. So what do we have? We have supply and demand. We have round level. We have monthly pivot, and we have the overall market direction, which is the higher time frame trade towards the downside. We do not care that there is monthly pivot point over here. We do not care that there is a round level over here, because the higher time frame context will likely push through this without much of a problem. The idea is we find a supply level that looks really good and then stack confluence to kind of give ourselves the best edge possible in the market. And these are the trades that are stupid simple, A+, and usually work out really well. And as you can see, it pretty much does exactly that. So stupid simple checklist: confirm the trend, find your zone, round levels, pivot points, and you're golden. So if you're serious about learning forex trading and want to grow your forex account fast, there's a trick I use in the forex market that actually helps you find more high probability setups than ever before. And the trick is we want to take advantage of stupid simple forex market correlations. This is Euro US dollar, this is GBP USD. The reason I draw them like that, freehand draw them, because pretty much they correlate 90 up to 95%, which means if Euro is pushing towards the upside, GBP USD is pushing towards the upside. If Euro is dropping down, likely GBP USD is gonna drop down. And if you find a setup that looks great on Euro US dollar, you can copy the same structure and setup for the GBP US dollar, which gives you 2 trades instead of 1, which doubles your speed of account growth. Of course, there is a possibility you lose them both, but you need to remember you not always get high probability setups in the forex market. You need a lot of patience when you're trading, and a lot of traders lack that. That's why they lose money. But with this technique applied properly, it can be a game changer to your trading game, I'm telling you. So let me show you an example. So let's say I want to trade Euro US dollar. Well, I want to mark this area of demand zone, maybe over here, because there was a nice little cluster, nice push, cluster, push, right? So rally, base, rally, just over here, currently pulling back in our demand area zone. So what I would do, I would go to this website, MyFX book, Forex correlations. Currently by the monthly stats, we can see that has been moving 93.2%, which means there's only 7% difference of movement. So you get the idea. We have Euro US dollar over here in the demand zone. Let's take a look at GBP USD. Look at this. Very similar. Nice little area of demand zone over here. This was a previous trade that could have been a potential trade towards the upside as well, because look, it formed on GBP USD like this. A nice drop, little base and rally formation. That could have been an entry as well. So forex correlations are not 100% accurate. There can be a little bit of a difference, but essentially you would mark one over here as well. This becomes a fresh zone on GBP USD. On Euro US dollar, as you can see, this is the fresh touch. We didn't have a strong reaction just yet, and we know that on GBP USD there is a new area of demand zone forming. So what can we do? We can long this position on GBP USD, targeting the previous area high, stop loss just below the demand zone, something like this. That seems pretty damn good. The same thing can be done on Euro US dollar, just over here. Stop loss can be way smaller and the risk to reward is way better on Euro US dollar anyway. So we set our stop loss, we set our target limit. Let's play the trade out, and as you can see, a beautiful trade going towards the upside, eventually pulls back one more time. Do we get a take profit? Yes, we do. And I believe the same thing has been done on GBP US dollar. So just take a look, very similar price structure. Just look at this, kind of climbing up, goes down. The same thing on GBP US dollar can be found. Look at this, climbing up, kind of consolidated, went towards the upside. Same thing happened over here, went towards the upside. Of course, we had that exhaustion over here. You know, you can't prevent it. It's not 100% correlations, but you get the point. And that's it. A genuinely simple trading strategy you can use. If you want to learn more, forextradingalliance.com, link down in the description below. And I recommend you guys watch this video next. You'll probably enjoy it. Take care, Lions. Have a wonderful day. Stay safe and goodbye.